All right. Good afternoon. Happy Friday the 27th. Welcome back to Wook Capital Management's weekly Wook and Review broadcast. This is Managing Director Rod Alsman here, and we'll be going through our prepared content to kick things off. I have probably about 30-40 minutes of prepared content, at which point around 4:45 or so, welcome anybody up who wants to chime in on any of the various topics we're discussing. Just to recap, first off, let me get a disclaimer out of the way. Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. Okay, that mouthful out of the way. I have a couple topics to get through today. There's been I'm going to go through kind of some antitrust discussion. There's a couple of cases, kind of RE Google and a couple others that I wanted to discuss a little bit. Obviously, the Bed Bath & Beyond default notice with the 10Q that came out yesterday. We'll talk a little bit about what's going on there, and this might be the end. We'll see for Bed Bath. And then a little discussion on the labor market. There's some different data points that I had come across over the last week or so I thought were interesting, showing some conflicting, I guess, data with maybe some narrative. So we'll talk about those items before kind of opening it up and welcoming anybody up who wants to add to the discussion. So again, if you want to follow video, I will have that live. I have it right now in the Wook Discord's voice chat. You can see my lovely face, and I'll be sharing my screen in a second here. So, okay, with that out of the way, just some programming notes as well before I get into the material. We have next Tuesday, this coming Tuesday, the 31st, our monthly book club. It will continue to be, unless we publish otherwise, the last Tuesday of every month at 8 o'clock Eastern. So this month, we've talked about it for a while now. We're going to cover Seth Klarman's Margin of Safety. You can find a free PDF online pretty readily with your favorite search engine. Maybe you're going to use Bing. Microsoft talked about them taking some market share, so perhaps that's your preference. And then we do have our weekly open mic discussions that I host on my personal handle with Joe, my @RodAlsman account. We're going to have that back Wednesday at 7:30. Next Wednesday. We're going to keep trying to do those on Wednesdays. We had done the Tesla earnings this Wednesday and we skipped it. I kind of like having those Wednesday open mics. So we will be back with that next Wednesday. The following week, the team will be doing some travel. We'll have the Wook and Review next Friday, the broadcast. We won't have it the following Friday. We are also going to move the open mic the following Wednesday. I believe we're going to do Tuesday, but you'll hear more from us next week on that. So we will be skipping the Apple earnings next Thursday that I had initially planned on covering, simply because I'm going to be traveling that day, and I don't think I'm going to be in a spot to broadcast it. So we will, though, next Friday spend the bulk of the conversation on like what's going on with big tech. We'll have gotten reporting at that point by the balance of the big tech players who are going next Thursday. So that'll be the conversation next week. So just some programming notes. Okay. Now let me pull up my screen, start sharing, kind of walk through some of the content I had prepared from the newsletter that went out this morning. Again, if you don't get that, you can follow the link in the Wook profile to sign up to receive those. We send them out every Friday morning at 9 a.m. It's a really brief write-up that we kind of expound on in this discussion for those who are new to the conversation. So, all right. We did host a Microsoft as well as Tesla earnings call discussions earlier this week. If folks want to talk a little bit about those once we get done with the prepared content, happy to. I already mentioned the programming that's coming up. So, yeah, we got a pretty big lawsuit from the Department of Justice and from several different states against Google earlier this week. So it's pertaining to DOJ perception that Google has longstanding monopolies in digital advertising technologies. And as you might expect, Google rebutted saying, no, we don't. There's a couple things I wanted to talk about. So for one, kind of just on the DOJ, I guess, side, I included a visual there in the newsletter, just kind of showing how much of the market Google has. The really Wall Street Journal article that I have on screen right now kind of talks about, and this was out earlier this week when the news came out on Tuesday, that basically the lawsuit is asking for the court to unwind Google's anti-competitive acquisitions, in particular the buy in 2008 of DoubleClick, and as well as divestiture of its ad exchange. So, quote, for 15 years, Google has pursued a course of anti-competitive conduct that has allowed it to halt the rise of rival technologies, manipulate auction mechanics, insulate it from competition, and force advertisers and publishers to use its tools. That was Merrick Garland at a press conference on Tuesday, the Attorney General. So we saw the lawsuit against Microsoft for the Activision deal from the U.S. government. Now this lawsuit from the DOJ against Google. Lena Khan at FTC has been talking for some time about Amazon's anti-competitiveness. So it seems like there's a resurgence in these anti-competitive threats for some of these mega cap tech players. Obviously, it remains to be seen how this DOJ lawsuit will pan out. I saw yesterday an interesting story, again in this vein of antitrust, talking about Vegas, which I will be in Vegas next week as part of that team-related travel. Looking forward to it, but the Vegas story is kind of in the same vein. The headline is Vegas visitors sue the Strip's biggest hotels over room prices. And the bullet points note MGM, Caesars, and Wynn are being sued over alleged algorithmic pricing. And basically, the lawsuit is alleging that the operators are colluding to overcharge for rooms through this profit maximization algorithm. So the suit was filed on Wednesday in federal court in Nevada. The plaintiffs are frequent Vegas visitors who claim they paid too much for their rooms as a result of an anti-competitive scheme. And they're suing these big resort companies, Wynn, MGM, Caesars. So the story goes on to note the suit is the latest in a growing wave of antitrust cases to take aim at algorithmic models or data brokering services allegedly used to facilitate price coordination across an entire industry. And the allegations echo dozens of recently filed claims hitting the country's top residential landlords with similar claims. So it's not one for one with the mega cap lawsuits against Microsoft and Google and prospectively Amazon, but it is this seemingly continuation of are these pricing algorithms anti-competitive? Obviously, the resorts have disputed that assertion, but it's interesting. The algorithm operator notes that they make recommendations to the hotels. They claim the recommendations they make to the hotels are accepted 90% of the time, or at least that's what the plaintiffs claim, and that therefore the algorithm is setting the price and not normal market forces. So we'll see, if that becomes a settlement, if those frequent visitors end up getting some maybe value so that they can stay cheaper next time. But they as well resort to defend against that lawsuit. So lots of lawsuits, lots of antitrust kind of going on. Again, if anyone wants to chime in once I get through the next two items, again, please feel free to come up as a speaker. All right, so the second item for today, Bed Bath & Beyond. They did file their 10Q yesterday, finally, after being quite belated. I'll pull up the Q on screen. You know, the takeaways were, I think, pretty straightforward. I'll scroll past the current financial statements, which just looking at cash and cash equivalents, you see they were down to 153 per November 26th per the, again, remember balance sheet, right? Balance sheet is a snapshot in time as of a particular date. So since that balance sheet date, the current cash, et cetera, that's all changed from any, activity that happened post-closing. But the balance sheet, showed continued deterioration as sales results continued to be weak. I'm gonna get here to page 9 where it talks about the liquidity and going concern. So this is kind of the new information. On or around January 13th, certain events of default were triggered under the company's credit facilities as a result of the company's failure to prepay an over, advance, and satisfy a financial covenant, among other things. As a result of the continuation of such events of default, on January 25th, so on Wednesday, the administrative agent notified the company that the principal amount of all its outstanding loans under the credit facilities, accrued interest, first and last out applicable premium, and all fees, etc., are due and payable immediately. The company is required, effective immediately, to cash collateralized letter of credit obligations, and effective the 25th, all outstanding loans and obligations shall bear interest at an additional default rate of 2% per annum. So Bed Bath is not bankrupt yet, but they are in default. And I would say that the preponderance of observers believe the next step is a bankruptcy filing sometime in the next several weeks. And the company notes in the 10Q that they do not have sufficient resources to repay the amounts under the credit facilities, which will lead the company to consider all strategic alternatives, including restructuring its debt under the U.S. Bankruptcy Code. So I had pulled a couple comments on this side of things. I thought I had pulled them. Okay, so this was today in Market Watch. Just to kind of build on that. So you have a bankruptcy practice partner at Green Spoon Martyr thinks BBBY bankruptcy filing could be imminent. Quote, my best assumption is they will file before the bank takes action to seize the assets. The loan documents most assuredly give the bank the right to take control of the company and the inventory. If there really was an equity for debt deal, it would have been announced to blunt the impact of the default notice. Another credit analyst noted they've edged closer to bankruptcy after defaulting on their loans. They struggle to find the cash they need to repay the debts. Creditors are now demanding immediate repayment. It simply doesn't have the money as sales continue to decline, losses swell, and it burns through cash. A bankruptcy filing could be just around the corner. The clock is ticking. So we've obviously talked about Bed Bath a few times. Last quote I'll pull is from another CEO of a credit ratings and consultancy who notes that generally in situations like this where a company defaults on their loan agreement, our experience is if they don't come to an agreement with their lenders, the likelihood of a bankruptcy filing within the next 30 days is relatively high. So they haven't filed for bankruptcy yet. They are in default, and they did after. I saw that they had hired another board member yesterday that was a restructuring specialist. I'm trying to pull that up. But the situation is really not good depending on where you are in the capital structure. So if you think about Bed Bath, and I know I have Chris R here in the audience, and he and I were chatting a little bit about some of the different options last night. So Chris, welcome your input once we get through the jobs discussion. But realistically, barring some sort of a deal where you could see a deal get done before they go into bankruptcy if someone, if they could strike the right price for, say, selling the baby asset. Let's say they got, $600 million. I think still the issue becomes that I just don't see, now that they're in default, how they can actually get themselves out of it opposed to bankruptcy. Again, I'll welcome other viewpoints or commenters to kind of chime in if they see any other paths. We talked about the bonds a few times in prior broadcasts, just to kind of get up to speed again on the bonds. They're trading again at deeply distressed prices. We're talking a nickel on the dollar for the 24s, a little under that for the 2034 maturities, and then 6 cents on the dollar for the 2044s. So they're priced that unsecured creditors will get very little, if any, recovery in a bankruptcy. You need to get through the secured creditors, the first and last out in ABL, and those folks have to get paid before the unsecured creditors have to get paid, who, after the unsecured creditors, assuming they were paid in full, which doesn't seem feasible or likely, then equity. BBVY stock has obviously traded quite incredibly for the last 6 months. You had the meme mania in August where it hit 30 briefly. Then, of course, you had both Freeman Capital Management and RC Ventures exit. The stock, traded down until earlier in January, when they noted they were likely going to be in default. Then there was another rally up to the $5 mark, and now the equity's back down to about $255. But still, it represents a market cap of around $300 million, which, if the equity, if they go through the bankruptcy proceedings, equity, it seems like, is almost certainly a zero here. So there's some interesting trade ideas that I've heard discussed. Chris R. and I were talking a little bit about last night, for example. If I can briefly, I'll pull up actually my TD Ameritrade Thinkorswim. Let me close all my personal information, but just to kind of show maybe some different ideas that we had discussed. And I haven't taken any trades in Bed Bath personally in my personal account. I thought this one was kind of interesting. You have the chain for Bed Bath all the way out to, you can open up all the way out to June 2025, for example, and Jan 25, you can get a little farther out of the money. So you could do something like, say, a call credit spread, or I guess if you're willing to bear the risk, you could write a call, a deep out of the money call on the equity, and you could use that premium to fund. There we go. You could use the premium, to fund the bonds prospectively. So Chris, when I get done through the job stuff, I'd invite you, if you want to mention that, or kind of talk about maybe how you're thinking about that. I know you are long the bonds, and I know you were talking about the prospect of getting involved with the unsecured creditor committee should the bankruptcy filing come in short order. But yeah, you figure the price on the bonds is about a nickel right now. If you could structure a trade in which you use premium from call rights, you're going to bear squeeze risk if you don't turn it into a spread position. But that's just one interesting way to potentially play if you think the bonds will get some recovery in a bankruptcy. Which I think the argument would be that they can, if they have. It seems that there might be a stalking horse bidder for baby. The baby asset, if you assume, $500-600 million that they could get for it, reading between the lines, I guess, reading what I've seen in reporting, they've been basically starving certain stores. Bed Bath has of inventory, while they've been keeping other stores replenished. The thinking being that they plan on shuttering a bunch of these stores that they can get out of the lease agreements through the restructuring, through a bankruptcy restructuring, and that the business could exist in a smaller state profitably. So all this is speculative. It's highly speculative. At this point, no one knows what's going to happen. I would venture that even Sue Gov and the Bed Bath board don't know what's going to happen. But it remains interesting. Okay, so then lastly, I wanted to talk about the labor market. So we had, there's a story in the Journal earlier this week talking about kind of a couple different slices of views. You can see temporary help for the last few months has seen 20 to 30 or so thousand cuts in terms of temp layoffs or temp help job declines. So the story posits that it could be not just that maybe there's some weakening. The story does note that temporary help typically declines into a recession, which a lot of the coincident data that we talked about from December, like the PMIs, retail sales, consumption, seems to be slowing and foreshadowing some sense of economic slowdown, even though you did have a good headline GDP number that came out for the fourth quarter at 2.9% growth. And of course, then weekly jobless claims fell again, and weekly jobless claims remain at extraordinarily low levels. So I guess the kind of mishmash of information coming in is that you've got companies cutting temp workers, which is typically a warning signal, but commenters note in the reporting that some in the staffing industry see another explanation: a declining number of temp workers equating with permanent hiring. And the fact is that unemployment is still at half-century lows, the 3.5% rate. That new jobless claims figure ticked down again week over week. So you still have a really tight labor market, which gets to the root of the problem, I guess, that the Federal Reserve has, because when you have companies like Walmart, the country's largest employer, they're raising hourly wages from $12 to $14 for starting wages, which the reporting notes that about a quarter, about 340,000 of Walmart's 1.6 million US workers will see a raise in their March paychecks related to the change. So there's, on the one hand, this is good for those who are employed at Walmart at that $12 an hour salary, who will see that 17% pay raise to $14 an hour. On the other hand, that 17% is a pretty huge pay increase, right? We've talked about the average hourly earnings increases that are out of line with what the Federal Reserve would want to be seeing. Then this would be further evidence that the labor market remains so tight that with these ongoing wage increases from large market participants like Walmart, that the Fed might feel the need to continue to tighten further in order to kind of let the air out of this super hot labor market. So you get the noise from the temp hiring. Is that a bad thing, or is it just another indicator that the full-time market is so tight? And we've talked several times in these broadcasts about the technology headlines. We keep seeing layoffs from big tech companies, but then when you really step back and you look, almost all of these major tech companies have a huge headcount increase versus pre-COVID levels. I had included a visual in the newsletter that the Odd Lots team included in their Odd Lots email earlier this week, which I thought was a really good visualization. It was the number of mentions across the S&P 500 company transcripts related to job cuts. And while yes, that those mentions are up big time from the lows in early 2022. If you step back and look over the last couple of decades, the job cuts are nowhere near the levels that job cut mentions of S&P 500 companies are nowhere near the levels seen in both the global financial crisis and during the COVID shutdowns in early 2020. They are also below much of the preceding decade after the great financial crisis, global financial crisis. So while they're up off the bottom, they're still relatively low, and that gets back to a lot of these metrics where, if you talk about things like delinquencies, they're ticking up, they're still low. Both the consumer credit side, I have seen that the automotive side is starting to get really questionable, and some we've talked about this at length. Your automotive lenders, automotive lending did well in the great financial crisis, and it seems like that might be the space that perhaps standards were loosened so much so, and now as asset prices decline and people find themselves underwater, it'll be interesting to see how things go in the automotive lending market. But yeah, this is just another one of those, I guess, good visuals that show us that while things have deteriorated from levels they're not anything like a true recession. The underlying data, while, as I noted, the coincident data continues to slow and deteriorate in some cases, it's not a recession. I don't think the data show that we're in a recession today, nor can anyone with certitude, right? We've people who've been calling for it throughout 2022 have a little bit of egg on their face, because that recession that has been called for, while it does seem like it's a very real prospect as 23 keeps rolling along, it didn't get there. And how much of that was companies and corporate and individuals having just really strong balance sheets from record fiscal stimulus and monetary stimulus over the preceding couple of years. It's very much a peculiar time. There's a lot of talk about bullwhips and how things are just getting stretched to one extreme and then pendulum swinging back too far, et cetera, et cetera. So I'm happy to welcome anyone to chime in with their thoughts, maybe what they're seeing in labor markets. Again, the blue collar labor markets remain tight. You see companies like Walmart raising wages. While job cut mentions are up, they're still muted versus historical levels. So it's still a pretty darn tight job market. And then next week, of course, we'll get the Federal Reserve, who will come and make a decision on what is priced in by the market is almost assuredly a 25 basis point hike. And then the question is, what is the messaging from the Fed? Do they feel that they will have to continue to hold rates high for the balance of the year, as they've discussed for a couple of meetings now, but the market is not pricing that. The market is pricing cuts by the back half of the year. So there's the school of thought, don't fight the Fed. There's also the school of thought, the bond market's always right. So somebody's going to be wrong. Very well may be the Fed once again. But if the Fed is cutting in the back half of the year, that would be a sign that the economic activity did in fact slow, and that there is in fact a whether it's a shallow recession, a soft landing, however you want to term it, that there would likely be earnings declines for corporations, which would make valuations even more stretched, and presumably equity prices, U.S. equity prices, would come down if it plays out that way. But again, no one knows. We're just trying to read these tea leaves together and see what we can figure out. So just looking through here, I think that's about all I had for prepared remarks. Got done a little bit earlier than we expected today. So it's 4:30 or so, 4:33. Chris, I'm going to kind of put you on the spot and invite you, if you want to chime in with some thoughts on the BBBY situation. I know, to the extent you're able to, and maybe share any of your thinking on the matter. You'd mentioned to me the possibility of getting involved with the unsecured creditor committee. Yeah, we'd love to hear you expand on that a little bit.
Oh, hi guys. Yeah. So there's a news piece of news that came out right now. Bed Bath and Beyond announced that they're closing Harmon. I don't know how many apes, BBBY apes, know that Harmon is owned by Bed Bath and Beyond, but that's just some news. I think they have like a few dozen stores. Um, Other than
Okay, yeah, I see it. I'm pulling it up on screen for anyone
yeah, I
following
sent you
along.
the
So
link.
oh, okay. Sorry. So Harmon, which is mostly beauty products, they had 52 stores in 6 states, and that it looks like that news came out a little earlier this afternoon, uh, that they'll be closing that. Okay. Yep. So so Chris, talk a little more if you're willing about the bonds and about maybe some of these trade ideas
Oh yeah.
structuring around the high volatility and the elevated equity value. Because I think that the conundrum, like if we step back and go all the way back to like summer of last year, the if you recall, I hosted Jake Freeman of Freeman Capital Management for a couple of Q&As. FCM had put forth a plan where they were proposing effectively the company taking advantage of the extraordinary volatility that was being priced in on the options chain to kind of harvest some of that volatility and find a win-win situation for creditors and for shareholders that would keep the company afloat. Obviously, the company didn't go through
Mhm.
and enact his proposal, and of course, equity still, though, as I noted, it's at $300 million, and it's hard to see a scenario where common stock comes out with anything but a big goose egg. Am I wrong?
Yeah, I think that the equity is in a lot of pain right now. It's they're in trouble. Given where the bonds are trading at, they're at around 4 to 5 cents on the dollar as of today. Um, and The coupon payment, I got a notification a few days ago that from my broker that I was to receive the coupon. But I talked to another broker, and they didn't know anything about it. They just said they would announce it once the coupon arrives. So I'm kind of skeptical whether they're going to pay it. I think there's a possibility that they do pay it, because if they file Chapter 11, it might take a while for them to get financing to restructure. Um, they have 30 days after a missed coupon payment to file. So, I mean, whether you believe that that's enough time to prepare is anyone's guess. But yeah, they're burning cash very quickly. So I think a imminent filing is probably in the cards for now.
And could you talk a little bit about, I mentioned the idea that unsecured creditors could get some recovery. Obviously, with, as you noted, the bonds trading at 5 or so cents on the dollar, not much of a recovery is being priced in right now. But what
Mm-hmm.
kind of a scenario would it require for unsecured creditors to get something out of the company if they move forward with a Chapter 11 filing?
Yeah, so if they file Chapter 11, I mean, what I'm going through in my head, I haven't really fleshed everything out, in great detail. But if they're able to sell off Bye Bye Baby for 300 million to 600 million would be great, right? Pay off most of the asset-backed loan, the inventory loan, which is secured credit, and then go through restructuring and wipe out all of the debt, basically, and the unsecured debt holders basically would have come out with equity. And the idea is that if you think the restructuring costs, right, and the cash burn, right, from now until bankruptcy is complete, if that's not greater than the value of the equity, right, um, you could be left with something that's actually valuable, right? This is a real business, right? They sell products, And without the huge debt load, one could argue that they could, the business could survive, right? I'm not saying equity is going to survive, right? But like the business.
I think that's the most important statement for younger investors and maybe folks who've kind of come up amidst the meme mania to really bear in mind is just because the the operating business could exist in a profitable capacity in the future in a different, if you remedy the debt issues and maybe the bloat issues, it doesn't mean that equity holders are going to come out of that in a good place. It kind of reminds me of AMC, right? We obviously talked about the extraordinary debt load that AMC has, the extraordinary ape movement that's really allowed them to continue funding the business by selling equity to apes, who then the company uses that to sell down, pay down some debt. It's not a magic silver bullet though. And the Chapter 11 process, now that they are in default, would basically allow them to restructure those debts and possibly keep the operating business alive. The Bed Bath & Beyond brand may remain. It may be a smaller operating business. But anyone who was YOLOing into Bed Bath & Beyond call options and shares may find themselves in an unfortunate situation if it plays out that way. And by unfortunate situation, I mean they may suffer a total loss.
Yeah, I was thinking about selling the call spreads for 2025. Short the 10, long the 15, right? So you'd have less exposure to volatility if the volatility runs, right? So if the stock goes to like 5 or 6, right, you're down a lot on the 10, but then you'll be up on the 15, right, because of the volatility. And the idea is that you would sell basically 2 of those, right? You would have $1,000 of exposure, right, and then you would buy 1 bond, basically with the proceeds, right? With part of one, like so you would basically help finance, right, a bond purchase.
The mid I see on that. So just make sure I heard you correctly. The Jan 25. You would sell the $10 call. You would buy the $15 call, a call credit spread.
Yeah.
And you'd get the mid is about 6 cents right now.
What, 6?
Well, that's the mid right now. It's a pretty wide spread. But if you could get that 6 cent credit, you could basically fund your bond buys, which the reality is that call credit spread likely expires worthless, but you've gotten a small premium, although in an odd scenario in which the stock moons, you're going to be underwater, at least on a mark-to-market basis.
Oh yeah, they are very. Wow, I'm seeing 6 cents. Yeah, I viewed it at close last night, so I don't think it was really accurate. I don't know if it's really worth selling the volatility. I mean, maybe, but yeah, it's just an idea. If you were, and also of course, like if the stock did some sort of Revlon squeeze or something,
right?
If the hard to borrow rate goes up into the thousands of percent, right, hundreds, like it went up to like 900%, I think, for Revlon.
There's early assignment risk on that short $10 if it were to run to 20 something. But I don't know. Anything can happen. Clearly, we've seen anything happen in markets. The last couple of years. But just some interesting trade ideas. We're not endorsing it. I don't. I haven't gone through in detail, but I guess the presumption is, and I guess the most recent reporting from Bloomberg today was that they don't have a bidder in place, which I'd seen earlier reporting. There was a stalking horse bidder. I guess the most recent reporting from Bloomberg today, 3 or so hours ago, is that according to people with knowledge of the matter, that their efforts to find a buyer in bankruptcy have stalled, and that is putting them on a path toward liquidation. Which, obviously, again, talks ongoing. A buyer could still emerge. So,
liquidation would probably be a pretty adverse scenario for bondholders, I think.
Yeah, because I don't see how in a liquidation you get enough
Anything, yeah.
to cover all the secured and leave unsecured creditors with anything. Yeah.
Yeah, that would be really tough, especially this inventory. A lot of it is own brands, so it's like private label stuff, and I don't know if they can liquidate that as easily, for a good price. So it would be tough, but yeah, I think another risk with the bonds is that the price you see is not necessarily the price you pay. So like when you buy bonds, you have to pay accrued interest. That's all the interest that's accrued since
That's
the
right.
previous coupon date. Yeah. So I mean, usually it doesn't really, when you're purchasing bonds, it's not really much as a percentage of your transaction, but at the current price, that's about 50% of the cost. It's 2.5 cents, and the bonds trade for around 4 to 5 cents. So
It looks like just I don't know if you saw in intraday it traded down to 4.3. It looks like maybe after that Bloomberg reporting in the afternoon came out that there was no
mhm.
prospective bidder. The 24s fell from about 5.5 cents to 4.3, although they
Mhm.
closed at 5. But yeah, you're right. There's the accrued
Yeah.
interest to
Yeah.
consider.
Yeah. So if they don't pay their coupon next week, then you're basically out that money. You don't get it back. So um,
Yeah,
I guess,
super high risk and speculative. Again, let
yeah.
me not understate that. To
Yeah. I think I
touch this
tweeted the other
security in any
day.
capacity,
I think I,
including short the common, which obviously, if they do file, you assume it'll trade as like BBYQ or something, and it'll probably trade for some cents. But yeah, uh,
yeah.
sorry, go ahead.
Oh, yeah. I was just going to say, I tweeted the other day that these bonds are trading like zero DTE calls.
Yeah, right.
But yeah.
So tell me a little more about what you've uncovered or learned, because I've never been involved in being a creditor in a bankruptcy, other than actually I own still a Lehman Brothers bond. I bought in 2007, so that's a great reminder of the foibles of trying to buy a high yield bond and think you're smarter than you are. But in terms of you own some of those bonds, and should they file, how does I guess what will how will things play out as you see it as a
So
creditor?
what happens is there's a bankruptcy trustee that's assigned by a judge, and I would have to go if I wanted to be involved in this. I would have to go and petition the bankruptcy trustee to become a member of the creditors committee. So there's an unsecured creditors committee and there's a secured creditors committee, right? And the secured creditors committee, they have a lot of say in. So basically, what happens in a bankruptcy is the company has 1 month. The management has 1 month to come up with a plan for restructuring, and then after that month is over, basically these creditors committees, they get to look at the plan and revise it, and give a counter proposal or other things, right? So it's a very long process. And to be on one of these committees is really good because you can advocate for your rights. You can be part of the discussion of a plan and make sure you don't have other interests playing against you. So to get on a creditors committee, you need to have or represent a large portion of the debt. So I mean that's the goal here, basically.
Well, I hope you're able to walk away with at least what you've put in. However this plays out, best of luck with it. It's been
Yeah.
just a really interesting thing to watch. Obviously, I have followed it for much of the last year, starting back with the RC Ventures involvement and of course Freeman Capital's involvement. So I'm just still blown away the company didn't sell more equity. Um,
Yeah.
over the tail half of 22 when when they could, and now they find themselves in this situation,
Yeah.
which is just unfortunate. I mean,
Yeah,
really,
it's really
again, this is
unfortunate.
death by buyback. The the prior management killed this company with a failed transformation and bought back hundreds of millions of dollars, in shares that are going to end up being, that capital return is going to cause the death of the company, it seems.
Yeah, it's hard to incinerate, capital like faster than this. I think. I mean, I don't know. I can't think of any other examples.
Yeah, this is a
Tough.
crazy case study. That's a fact.
Yeah.
We will see how it resolves itself, but yeah, it unfortunately does not look good for anyone long in this one. Well, best of luck should it go to the creditors committee, and I'm sure you will keep us updated as things progress. I know bankruptcy is not a quick and easy process, and it may be many years before you see any prospective recovery, but definitely, hope it works out. Maybe a last minute white knight will show up and decide they want to buy some of the assets.
I
Who
hope so.
knows? um, it was an awfully meme mania kind of day. Again, I know we ran that last week. Obviously, Bed Bath didn't participate in it, but when you look at some of the, I guess, different meme type stocks, Carvana was up 20%. I know Lucid had a crazy squeeze earlier today and closed up 43%. The indices at large, of course, were up, led by tech and growth, and I guess interest rate sensitive names. Consumer discretionary from a sector perspective was up big. And in my personal account, I actually added some XRT, the retail ETF, January 24 puts, because if you look at retail as a sector, it over earned like crazy in the pandemic, and it's just still valued at really, like, if you look at trailing PEs, it doesn't look on its face like it's rich, but it gets back to how much like excess. Let me pull up XRT on the screen. Just like how much excess EBIT came through for retail in 22, 21, and XRT is relative to pre-COVID. It's still like 50% higher right now, and it's obviously made a nice move off of the lows. It's up like 20 or 25. But that one, I just think retail has a lot of pain coming down the pike. I know we've had Paul Saros talked about it, and we've kind of had him on the open mic about his view and some retail names. But I don't know. I'm on the edge of my seat here when I think about where the risk reward is. I don't think the risk reward is up, but on the other hand, bears have been taking it on the chin the last to start the year. I mean, the Nasdaq's up about 15% from the late December lows. The the Goldman Sachs Prime desk I saw earlier this week. Some of the short covering is in like we're talking multiple standard deviations away from the normal. So a lot of short covering. I've seen data that retail is buying, which I guess I don't view that as a bullish indicator. I view that as over the last 2 weeks, there's been a lot of retail investor inflows into the market. It smells more like a chase to me, which maybe I'll be wrong, and this is not a bear market rally, and it is in fact the start of a new bull market. But a lot of that activity reads to me like a bear market rally. Bears are getting their faces ripped off. People are getting greedy and chasing it. We do have the Fed next week. Financial conditions, depending on which index you're looking at, are actually looser than they were when the Fed began tightening. Again, it depends which index you're looking at, whether you look at Goldman's, Bloomberg's, or the Chicago Fed's. But with all of that financial condition loosening from asset prices inflating and bond yields coming down, in the context of the labor market, again, the supply issues in the labor market won't get resolved overnight. The missing millions of workers are not going to appear. And that gets back to the Fed is armed with a very, they have a hammer to try to surgically solve this issue of decreasing demand. That hammer is the Fed funds rate, and we'll see what happens. It wouldn't, I guess, surprise me at this point to see the bubble reflate, uh, and to see stocks continue to rally. But I just struggle to see with a lot of, as I mentioned earlier, the coincident indicators. You see manufacturing continuing to weaken. We talked about the New York Fed kind of manufacturing survey data come out as like one of the worst prints of all time. So there's a lot of deceleration, I guess, in what looks like it's happening in real time in certain parts of the economy, but the consumer just keeps on spending, and a lot of the banks keep reiterating the consumer has a lot more money in their accounts than they did before COVID. So even though savings rates are around all-time lows, that the consumer does have some capacity to continue to spend. If they're a homeowner, they have a house that's still relatively inflated in value, and they may be feeling confident in their capacity to spend. And going back to again relative discussion, consumer borrowing has begun to really escalate in terms of borrowing outstanding. But then in the context of historical default rates are still, it's still low relative to normal, even though they may be rising on the consumer credit side. It's still low. So who knows, right? Again, what comes next, but it doesn't strike me as a very attractive market to deploy long-term capital into, which is why both myself and the fund are very overweight cash. I'll leave it at that. Joe, obviously we got Chris up. I don't know if there's anyone else in the audience who you might want to pull up and force them to talk, but yeah. Any other thoughts, Joe?
Yeah, I would just say, I mean, I think everyone kind of saw this coming with Bed Bath. There probably will be another Fool's rally soon enough, and I think we'll won't even have to do another. We did a poll a few weeks ago whether or not we thought the rally in Bed Bath was driven by retail or not, and most people voted no. And I mean, I continue to believe that there's funds out there that trade in a way to manipulate retail into trying to hop on and chase, and that's what I continue to believe happens with these meme stocks.
Yeah, it. I mean, it's hard to say one way or the other. How much of it's retail, how much of it is institutional. I certainly don't think it's only retail, and clearly, it's not like retail investors are in some sort of a coordinated effort to all put trades through at the same point in time. It just doesn't seem plausible. I think the explanation is likely there's certainly funds that are in Reddit's subs, probably trying to push sentiment one way or the other. Yeah, I just have on my screen the S&P. Just not that it's the best of proxies for short interest, but the SPY as an ETF, that short interest is actually relatively low versus where it's been over the last 3 years. I know Mile High stock guys listening, and I know he's a technical kind of focused trader, but he had shared a data point that someone had shared. If I can get the right data point, it was basically showing that retail speculators have been bidding up, what is it, small trader put buying. Small trader put buying at really elevated levels, kind of all-time high levels. So, do you need to see the small retail, I guess, put buyers get wiped out and capitulate before maybe this bear market rally is over? Who knows? But just another data point. And then lastly, I'll just pull it up, the fear and greed index that CNN's got here. If we look at the timeline over the last year, we're back to the greediest that this index has shown, since the beginning of 2022. So even during the August rally, it never got to this level. It touched 70 earlier today. It looks like it closed at 69. In August, it got to 68. And then, of course, the Fed chairman came out and sent equities scurrying. So we've got the Fed chairman on, I think it's Wednesday. It's Feb 1st. What day of the week is that? That'll be next week, though. And yeah, on Wednesday we'll have the Fed chairman out, and we'll see. As I mentioned, the loosening of financial conditions, the elevated asset prices, and the return of some euphoria with a lot of these memes rallying. Does the Fed want to see asset prices keep going higher? Will the chairman explicitly make a comment regarding equity valuations or equity prices? Remains to be seen, but it does seem like that's the next major event to come for where the market heads to. Otherwise, the Fed, again, it's fully priced that they will do 25 basis points. The Fed Watch tool at CME, it's I looked earlier, it was 99% for a 25 basis point hike, and now it's showing 99.2, so 99.9. So it's priced that there is a less than 1% chance of a 50 basis point hike. So what does that mean? If a 50 basis point hike comes, the market is not prepared for that, and that would likely send asset prices downward. But with the kind of language from the Fed speakers over the last few weeks and the data that's come out, it does seem like they're not going to go to shock the market. They'll likely come through with this 25 point hike. At least that's what is priced. And then it's still priced that there will be another hike in March. And then the question is that it? So people will be looking for language from the Fed in next Wednesday when the chairman speaks around what they're seeing and saying. They've obviously, again, said that they don't plan to cut rates anytime soon, and the market is pricing differently. So yeah, we will see what happens there. We won't be playing the Fed live. We had done the last couple of Fed FOMC meetings. We'd kind of played live on Twitter, but I will, if I'm able to. I might have a conflict, but if I am free during that time, I will try to live tweet on the Wook handle, kind of the Fed speakers' comments and the Q&A as I've done. But yeah, that's what's going on in rate land and in Fed land. What else? Yeah, crazy rally in Tesla today. The stock is now up 31% in the last 5 days. It's up almost 60% in the last month. So it's added many hundreds of billions of dollars, which is normal, I'm sure, in some world. I don't know if anyone has any thoughts on Tesla. We of course did have the earnings call earlier this week, which Joe has posted on the Wook Capital YouTube. Elon is Elon, and he's a fantastic salesperson, and he had a lot of positive comments during the call that clearly has reinvoked some of the animal spirits with the stock being up so much over the last couple of days and since the earnings. But again, it gets back to valuation. It hasn't mattered for Tesla, and it's not that it's going to matter soon, but the forward price to earnings that people were touting in December as getting very potentially attractive, again, looks awfully nosebleedy with a forward PE closing in on 50 after today's rally. So yeah, discretionary had a great day. Will it have a great month or year to come from here? And it's always what happens next and what the forward returns look like. And it at least in the near term looks, I think risk is skewed to the downside for Tesla, but that hasn't mattered for a while now. The multiples that got down toward levels that if we call them a technology company rather than an automaker, they were starting to potentially look attractive in December. They've again blown out now with forward EV to EBIT, which management told us in the earnings call to focus less on gross margin and to focus more on operating margin, which if we look at EBIT as a proxy for operating margin, the enterprise value to EBIT is back up to 40 times, which is just extraordinarily high multiple, which means there's a lot of growth baked into the price. And they claim that they can continue to meet that 50% CAGR that has been their long-term aspiration. It will be interesting to see how it plays out. Microsoft, we had the call earlier this week. Microsoft initially reacted negatively during the call. They talked about growth decelerating for the cloud business, which is their high growth biz. The entire enterprise is now at the slowest growth since like 2016 or 17-ish. So again, you're paying a very hefty multiple for the forward earnings for Microsoft, but it does not appear that, at least in the near term, there will be much growth. So the question becomes, is Microsoft, again, priced for perfection? A lot of these mega caps have seemed to be priced for perfection. They've obviously, many of them declined meaningfully from the all-time highs and from the extraordinary levels that they got to in 2021, late 2021, where Microsoft peaked at a forward enterprise value to EBIT of about 30 times, which, if you go back through the company's entire history, it was never that high. And while it looks a lot more attractive at 20 times forward EV to EBIT, again, that multiple is completely out of whack with where the company has traded prior to really the mega caps going hog wild from 2017 onwards. So again, you could probably get a decent return. Are you going to get meaningful alpha from here? I don't know. Obviously, Satya kind of set the tone during the Microsoft call this week that they see AI as the next evolution of kind of giving them further growth opportunities throughout their business. So still, though, it does not look cheap. It's a great business. It's clearly, it was cheap at points in the last about a decade ago. You talk about it was at a 5 times EV to EBIT a decade ago, and now it was at 30 a year or so ago, and it's at 20 today. What's the right multiple? Maybe it's not 30, maybe it's not 5. Is it 20? Is it 15? Is it 25? In the context of risk-free interest rates being where they are, I struggle to see why it should go much higher, but anything can happen. So that's about it, I guess, from me on Microsoft and on Tesla. I'm just looking to see if there's any questions from anyone. And I know some people don't like to speak on the broadcast, and they'd rather communicate via text. I don't see any, Joe. Joe, I don't know if you have any outstanding. Might make it a short week this week if no one wants to share any more thinking.
I would just add that we're considering some more series ideas for Wook, and if anyone has any thoughts on our proposal to do a bear versus bull series, where we get someone who's bullish on a stock and someone who's bearish on a stock to come in and debate, we think that'd be a really fun idea. So anyone who wants to propose a company or a ticker, and maybe they're bullish on it, maybe they're very bearish on it, and they want to go up against somebody else and get into a civil debate, that would be great. Let us know. You can either message me, you can message Rod, you can message Wook. Well, that's just one of the different ideas we have for 2023.
Yeah, that is. Thank you for sharing that and reminding me to bring that up. It clearly, the great thing about space is you can get a lot of different perspectives from people all around the world, and a lot of the times you can have some really good discussions, even if it's a heated discussion with people with different viewpoints. I've been happy with how our conversations have gone in these different open mics that we've hosted. They're generally very civil and gone very well. I think that it's fun to listen to two sides of the argument. So like a bull versus bear series is something that, as Joe noted, we're very seriously exploring. If there's any particular securities that people want us to try to pull maybe some popular bulls or some popular bears in and set up some fun dialogue, please, again, communicate with us. via DM, or you could just at me or at Wook Capital. I think that would be fun. That's definitely something we're exploring. I had mentioned an interview series. That's something else we are really want to work toward as 23 keeps progressing. If you have any ideas for future book club readings, we do have channels in the Discord that we'd happily entertain any feedback on where we should go next, since Tuesday we will have margin of safety, and then February will come around the corner and we'll be talking about the next book. So yeah, any ideas for any of those things, we would love to hear your feedback. I will be participating in a podcast next week. I suspect it will get released sometime on Allison Transmission, which many folks know I've been a big fan of and spoke glowingly of their business and why I think they're misunderstood for some time. So that will be coming out as well. And we'll continue to kind of pick and choose some earnings calls. I think we're probably going to target about one per week as opposed to the 1 to 2, just as we get our bearings and have our capacity. As I mentioned, not next week, but the one after, we have some ongoing travel. So we'll just have a little bit of a change up with our broadcast schedule. But yeah, I think that about covers it. Any bulls or bears out there that want to chime in? Come on up. Okay. Last call for alcohol. All right. Well, with that, then we talked about Bed Bath situation. We talked about the continued tightness in the labor market, some different metrics. We looked at some of these different antitrust suits that keep hitting the headlines and flowing through. And we will be back on Tuesday, so very much looking forward to the margin of safety discussion. Again, if you haven't read the book, if you don't plan on reading the book, I think there's hopefully going to be something for everybody. We will be having that on Tuesday at 8 o'clock here on Twitter Spaces, and then we'll be back with our open mic on Wednesday and our Wook and Review next Friday. So thank you so much again, everybody, for tuning in to this edition of Wook Capital Management's Wook and Review. I'm Rod Alsman. It's been a pleasure. Hope everybody has a nice balance of their day and a great weekend, and we will talk soon. Cheers, everybody.